Welcome to The Deep Dive, your express route to understanding what really matters in the latest business news.
Glad to be here.
Today, we're cracking open the recent earnings call for Fox Corporation. We'll be pulling out the key financial figures and strategic moves you need to know about.
Yeah, think of it like getting the crucial details without wading through the entire transcript.
Exactly, trying to understand what's actually going on.
And this quarter really shows a media company, leveraging those big events, leaning into streaming with Tubi, and positioning itself for what's next.
Okay, so let's dive in. At a glance, what were the headline numbers? Total revenue looks strong.
Very strong. A significant climb. The main story there was advertising revenue. Huge surge. Jumped by 65%.
Wow, 65%. What was behind that?
Well, a massive piece of that was the Super Bowl. That brought in over $800 million across their different platforms.
Right, the big game effect.
Definitely. But importantly, it wasn't just the Super Bowl. There was solid underlying strength in advertising, too.
Good. Good to hear it wasn't purely a one-off boost. And affiliate revenue, that also saw a bit of growth.
It did, yeah. Affiliate revenue ticked up by 3%. And another big highlight, they hit a new record for free cash flow.
A record? How much are we talking?
Over $1.9 billion. That's really strong. It shows good operational efficiency, good handle on working capital, gives them a lot of flexibility.
Okay, flexibility is good. Now, profitability adjusted EBITDA was actually down a bit year over year.
That's right, a slight dip. It landed at $856 million, down from $891 million last year.
And the reason?
Primarily those increased costs tied to broadcasting the Super Bowl. The rights fees, the huge production expenses. That directly hits the bottom line in the quarter the event happens.
Makes sense. But interestingly, adjusted EPS, earnings per share, that actually nudged up slightly, $1.10 from $1.09.
Yeah, exactly.
Yeah.
So despite those higher costs impacting EBITDA, other factors helped on a per-share basis. Things like their share buyback program likely played a role there.
Okay. Interesting dynamics. Let's maybe dig deeper into the segments now, starting with cable network programming.
Sounds good. So cable had a healthy quarter. Revenue was up 11%. And EBITDA, that's earnings before interest, taxes, depreciation, amortization, and rent, that was up 7%.
And the driver there, still Fox News.
Fox News continues to be the powerhouse.
Ah.
Yeah. Strong linear ratings, but also growing digital engagement. That's key.
And how did the money break down within cable? Advertising revenue
Jumped significantly, up 26%. That was driven by both national advertisers and direct response advertisers paying strong prices.
and affiliate fees, the money they get from cable companies.
Also up by 3%.
That's still growing despite, everyone talking about cord cutting.
It is. And what's fascinating is the price increases they've secured in their contracts are actually more than making up for the revenue lost from people dropping cable.
Huh. So the rate increases are really working for them.
They are. And interestingly, the rate of those subscriber declines has actually been getting better, slowing down
Yeah.
the last 3 quarters.
Okay. But expenses were up in cable too.
Yes, mirroring the overall theme, higher costs mainly due to sports rights amortization and production.
Got it. Okay, let's switch over to the television segment then. Big picture there.
Also, big growth. Revenue jumped 40%. And again, the Super Bowl was a major factor.
Right. But like you said before, what about underneath that? If you strip out the Super Bowl.
Even excluding the game, they saw solid underlying advertising growth. And a big part of that was Tubi, their streaming service.
Tubi keeps popping up. We'll definitely need to circle back to that. What about affiliate fees for the TV stations?
Also positive, a 4% increase across both the stations they own and their affiliates.
So revenue growth pretty much across the board in both big segments. But those Super Bowl costs are definitely a theme on the expense side.
Precisely. Expenses in television were up significantly, mostly the Super Bowl, but also their ongoing investment in building out Tubi.
Which means EBITDA for television was down year over year.
Correct. The higher costs weighed on profitability for that segment in the quarter.
Okay, let's drill down on Tubi then, because it sounds like a really crucial piece of the puzzle.
Absolutely. Tubi had another really standout quarter. Its revenue growth actually accelerated up 35% year over year.
Accelerated. Better than the previous quarter.
Yeah, it was 31% last quarter, and that quarter even had the boost from political advertising. So 35% this quarter suggests real building momentum.
And it played a role in the Super Bowl, too, you mentioned, extending the reach.
A big role. They saw over 24 million unique viewers just on Tubi for the game. Peak concurrent viewing hit 16 million.
Wow. Any insight into who those viewers were?
Yeah, what's interesting is a significant chunk were younger, 18-34, and also a lot of female viewers. Shows pretty broad appeal. And the game itself was a huge acquisition tool, brought in over 8 million new registered viewers to Tubi.
The question is always, do those new viewers stick around after the big event?
Seems like they are. In April, after the Super Bowl buzz died down, total viewing time on Tubi was still up 24% compared to last year.
So good retention. People are engaging.
Exactly. Management sounds very bullish on Tubi. They clearly believe it's undervalued in their current stock price and has a lot more room to run. It just crossed $1 billion in revenue for the trailing 12 months, too.
$1 billion. That's significant scale.
Definitely puts it on the map in the AVOD, the ad-supported streaming space.
Okay, shifting slightly. They also talked about their direct-to-consumer plans, this Fox One service. What's the latest there?
Right, Fox One. It's still on track to launch before the fall football season kicks off later this year.
And the strategy? Who are they targeting?
It's pretty deliberate. They're aiming the pricing to align with their wholesale rates and specifically going after the cordless market, people who've cut the cord or never had cable to begin with.
So they're trying not to pull people away from traditional cable subscriptions, avoid cannibalizing themselves.
That seems to be a key goal. You want this to be additive, reaching that audience that isn't currently paying for a traditional bundle.
How will they reach them?
They mentioned planning partnerships with other distributors and services to make Fox One easily available. But interestingly, they also said it will be available to their existing traditional cable subscribers too.
Okay. So existing subs can get it, but the main push is for the cordless market.
That seems to be the focus, yeah.
Let's talk advertising trends more broadly. Anything else stand out?
A couple of things on Fox News. They noted they attracted a significant number of new advertisers after the last election cycle.
And are those advertisers sticking around?
Apparently, yes. They emphasize that these new advertisers are continuing to run campaigns, which suggests they're finding value there.
Any other ad trends?
Yeah, direct response advertising on Fox News saw substantial growth. And scatter pricing, the ads bought closer to airtime, was significantly higher than the upfront pricing. That points to strong immediate demand for ad spots.
Okay. Let's look at the company's financial health balance sheet.
Looks pretty solid. They have a healthy cash balance, around $4.8 billion. Debt seems manageable.
And capital allocation, buybacks.
They've been active there. Bought back another $800 million worth of shares just this year. That brings the total since 2019 to $6.4 billion. It's about 30% of their outstanding shares bought back.
And they plan to keep going.
Yes. They reiterated their commitment to completing the full $7 billion authorized program. They also just paid off a $600 million debt that matured.
So looking ahead with capital, more buybacks, investments.
Seems like a balance. They'll continue buybacks, but also invest organically in the business, including funding Fox One. They also mentioned the bar for M&A for acquisitions remains quite high. They're focused internally right now.
Got it. Now, there's this interesting FanDuel option Fox holds. Any update?
Right. The option to buy a significant stake. 18.6% believe in FanDuel by the end of 2030. They're actively working through the state-by-state licensing process needed for that.
It sounds complicated.
It is. Involves regulatory approvals in each state.
Yeah.
But management sees significant value there. They estimate the option's intrinsic value could be around $2.8 billion based on current market comps versus their exercise price.
So they definitely intend to exercise it.
That's the plan, yeah.
Yeah.
As they get the approvals over the coming years.
Okay, let's look further out. Fiscal year 2026. What are the big moving parts we should talk about?
Well, a couple of key differences. Fiscal 26 won't have the political advertising revenue you see in election years. That's a headwind.
Right.
And the Super Bowl, which was in this fiscal year, was actually a net cost this time around. So its absence in FY26, from a profit perspective, isn't necessarily a negative.
Any big events coming in FY26?
Yes, the FIFA World Cup starts in the latter part of fiscal 26 and runs into 27. That'll be a big opportunity for them.
And the underlying trends. Advertising, affiliates.
They expect continued strong tailwinds for advertising at Fox News and especially Tubi, and continued growth in affiliate revenue.
What about spending?
That's the swing factor. The level of investment they decide to put into Tubi, balancing growth and profitability, and the investment needed for the new Fox One service, those will be key things impacting the bottom line in FY26.
We touched on Tubi investment, but any word on broader digital spending?
Tubi is definitely the main focus, trying to find that right balance between investing for growth and moving towards profitability. But overall investment in their other digital properties seems to be staying broadly consistent.
And just one last detail, The Fox lot in LA, something about Disney leaving.
Yeah, a minor point, really. Disney is vacating some office space there, but it's office space, not production facilities. And it's less than a third of the total office space on the lot.
So Fox isn't worried about filling it.
No, management sounded confident. They view it as highly valuable real estate in Century City and don't anticipate any problems finding new tenants.
Okay, so let's try to pull this all together. For someone tracking Fox, what's the main takeaway from this quarter?
I think it really underscores the strength of their core assets news with Fox News, live sports, and now a significant entertainment play with Tubi.
The advertising picture seems healthy, even beyond the Super Bowl bump.
Absolutely. That underlying strength is important. And Tubi's growth is undeniable. Its engagement metrics, crossing that billion-dollar revenue mark, position it as a really serious player in ad-supported streaming.
And the Fox One launch is a big strategic move to watch.
Definitely. Targeting that cordless market is crucial as viewing habits shift. Plus, their ability to keep growing affiliate revenue despite cord-cutting pressures is pretty noteworthy.
And all underpinned by a strong balance sheet and disciplined capital return.
Exactly. Gives them flexibility and a solid foundation.
All right, that brings us to our This Is Not Financial Advice segment. Time to put on our speculative hats, look at everything we've just discussed. Fox's strength in live content, the move into DTC with Fox One for the cordless crowd, and maybe Tubi still being undervalued.
Okay, so here's an outrageous but plausible thought experiment for you. Given all that, what if you considered a long position in Fox Corporation itself, but to potentially hedge against, broader market shifts away from linear TV, maybe simultaneously take a long position in a pure play AVOD competitor, one with less exposure to the traditional side.
Interesting. So long Fox, long a pure play streamer as a sort of pairs trade. What's the core idea?
The thesis would be something like, Fox One does successfully capture a chunk of that growing cordless market, and Tubi continues its strong growth, eventually forcing the market to recognize its standalone value more fully within Fox, driving shareholder returns. The hedge protects a bit if the broader cord cutting accelerates faster than expected.
Got it. A way to play both Fox's specific strategy and the broader streaming trend.
Exactly. But, and this is crucial, this is purely a hypothetical scenario. It's absolutely not financial advice or a recommendation. You must do your own thorough research, consider your own risk tolerance, and consult with a qualified financial advisor before ever making any investment decisions.
Well said. Always do your homework. So that wraps up our deep dive into the Fox Corporation earnings call. We covered the impressive revenue growth, the dynamics in cable and TV, the really exciting stuff happening with Tubi and Fox One, and those key financial points.
Hopefully it provided some valuable insights into where the company stands and where it might be heading.
We trust it gave you a clear, concise understanding. As always, we encourage you to dig deeper yourself, look at the source materials, and form your own informed opinions. Thanks for tuning in.